Alright, welcome to another video. This is a walkthrough of the weekly S&P 500 chart storm. Just getting straight into it, we have the first one here. The S&P 500 closed on Friday, with a little bit of an error in the tweet there, but closed Friday at just above the 200-day moving average. So pretty much at a fork in the road there, critical point. Monday is going to be a pretty key day really. And we're going to get into Monday in a little bit more detail in some of the coming charts. But this one kind of sets the tone and shows you, you know, what we just been through. The last two trading days of the week really just had a bit of panic setting in as the news, or the noise, as some people like to call it, you know, triggered off quite a turn in sentiment there. So looking at, so most people, you probably would have noticed that the blue line there is the 50-day moving average, and spent fully the whole last week below that. And you know, if you look at the breadth for 50-day moving average, it shows you that 86% of S&P 500 companies are now trading below their 50-day moving averages. So really what that says is that the participation in this correction has been quite broad-based. So you know, it kind of tends to make it a little bit more meaningful in that sense. I guess the other point to make on this chart, you know, so obviously breadth is looking pretty weak, but at these levels it's also looking oversold. You know, so it's around these kind of levels here. You know, when we had Brexit, then they had the corrections there in the first leg of the downturn, the correction rather, that that you have a raised or elevated odds of a rebound from this point. There's one to note, keep that in the back of your mind as we progress. And the number 3 chart is breadth again. This is 200-day moving average breadth, and there, you know, according to democracy, the S&P 500 is actually breaking below the 200-day moving average, of 53% of stocks now trading below their own respective 200-day moving averages. A couple of things also to note on this chart. So if you compare it against the 2015-16 corrections, you know, it hasn't, you know, it's still, I guess you could say, winning the war. You know, it's clearly losing the battle on the 50-day, but still winning the war, I suppose you could just say, or that it's, you know, it's kind of 50-50. Yes, we come back to that. You know, one thing that I would note is that this one is really being a sentiment-driven correction. I mean, of course, you had the Fed last week raised rates again. I look across a number of different indicators I have on the impact of interest rates with Fed policy and markets, and I talked about this in depth in the weekly macro themes report went out to clients on Friday. That we're probably still only about halfway through where those indicators usually have to go before they become, you know, majorly bearish for the market. So, you know, I would not be saying that, you know, it's Fed that's driving this turn or a potential bear market. The other thing I'd note is that, you know, there has been a lot of bad news or bad noise in the market, but contrast that to 2015-16, where a lot of economic indicators and earnings numbers were actually turning down at that point, and you know, a big part of that was you know, concentrated on commodities, but we haven't really seen anything like that just yet. So that's one reason that I'll come back to at the end, which I think there's a reason to not be fully bearish at this stage. And another breadth chart, this one is showing you the 52-week new lows. It has moved up just a little bit more than the first leg down of the correction. And you know, what else can we say about this? It's not as high as it got to in those 2015-16. So you know, on that, you know, you could potentially make the argument that it has got a little bit further to go. But again, you know, sort of showing you the breadth is deteriorating a bit there. Moving on, this one here is one of my favorites. It is a 12-month rolling or annual rolling count of daily percent changes in the S&P 500 which exceeded 1% plus or minus. You can see it's turned up from a 50-year low to now at the same levels as 2007, and it's interesting there to sort of pause and think about how this particular indicator behaves. You know, most of the time when it turns up from an extreme low, that's actually the start of a major topping process. So if you look at, you know, 2007, you know, even into the 2015 correction, it had started to turn up, and you know, in the 70s there and the 60s, a few times it's done that. So I would say that it's, you know, typically a bearish signal, typically something that is not great to see. But then, you know, in the early 80s there, you can see it started to turn up without necessarily, well, actually that was, you know, sort of the later stages of that bull market before that big crash here. And again in the 90s it started turning up in the 94, 95, and you know, continued to stay elevated throughout the later stages of that bull market, climaxing at the bottom of the bear market there, which is quite an interesting thing, and it's a reason to keep this chart on the radar throughout the market cycle, because, you know, if indeed this is actually a topping signal here, then we'll want to be keeping an eye on it for the eventual buying signal. And on a very similar note, actually, this one called the Euphoria meter, and this is my own one, and it's made up of these three ingredients here below, which is the forward PE ratio, composite bullish sentiment from the investor sentiment surveys, AAII and the II ones, and smoothed VIX. And basically, by including these three different things, it's giving you both a market view and a surveyed view of you know, where investor sentiment is sitting. And yeah, quite interesting really how it's come back from the highest point since dot-com boom, almost reclaimed the highest there, not quite, but then now it's gone back to April 2017 levels, and so it's completely unwound that last little bit of hype that drove that last leg of the bull market there. The bearish interpretation of this is that it doesn't usually make these kind of falls, you know, except for when the market's rolling over, like, you know, in the early 90s, a little bit of a, you know, decent correction in the 94 there. Of course, the rolling over the dot-com boom, the fall in this indicator in the later stages of, well, in the early stages of the financial crisis, and then, you know, into that 2015-16 correction there. The exceptions would be, and I suppose you could look at that example when in 2004, 2005, where it did come down a bit, and that was just in the, you know, pretty much in the middle of the bull market at that stage. The Asian financial crisis, all LTCM, all the other drama that was going on around then, it did drop quite a bit, and then you know, we still had a little bit left in that one. And then also, I suppose you could point to that there one too, in, what is it, 1992. So, you know, it leaves room for interpretation, and that's, you know, on first glance, or first impression, you might think, okay, well, this can be interpreted two ways. So how actually useful is it? But it is quite useful because it's you know, leaving room for interpretation means that you know, it's not a foregone conclusion about what's happening with this market, and given the weight of evidence, it brings you to an interesting conclusion, which I'll talk about at the end. Number 7 is a table from Odd Stats, which is an interesting new account come to Twitter. Definitely worth following that. He produces some odd stats. Pretty interesting stuff, really. And yeah, looking at the right hand side of the table, that's what happens on the next trading day, i.e. the Monday. Most of the time it's a Monday, following a bad Friday. And it was a minus 2.1%, I think, 2.11% down on Friday. And this is showing you the average, what happens next, and it's 50-50. It's, you know, half the time the Monday was down, half the time the Monday was up. The average was down, and you know that's possibly skewed by a couple of notable occasions. But interesting also is how the subsequent 5 days were actually not too bad, a little bit better than certainly the next day. So you know, it's something to think about for Monday, but you know, again, it's not, I guess the actual ultimate conclusion is that it could go either way. And you know, how Monday turns out the next couple of days is going to be probably pretty key, actually. Next one, pretty interesting. This one, it's a little bit out of date because you know we've obviously had this next leg down, and if you were to update it, that black line would be down around here, and it would be looking like that average that red line there, actually looking more like the red line than the green line. And so the green line is what happened on average during a 10% or greater correction within a bull market, and the red line is what it looks like at the start of a bear market, as defined by Ned Davis Research. And yeah, that was posted by Will, and you know, very worthwhile following that account. Very good. And yeah, so it's looking more like the start of a bear market, not strictly on this chart alone. Moving on, number 9, zombie apocalypse on the horizon. This one is showing you the percentage of Russell's 3000, so that's not Russell 2000, it's this is a broad index. So if you think about the Russell indexes, there's the 1000, which is the large caps, the 2000, which is the small caps, and then the 3000 are all caps. So yeah, 16% of companies have got interest expenses which exceed or match the EBITDA, so earnings before interest, tax, depreciation, and amortization. And that's really just saying, you know, what companies can't afford to pay their interest. And yeah, it's been steadily on the rise there, which is kind of interesting. You know, usually this one would really surge going into a recession. You know, obviously the interest rate charged matters, but you know, it's going to be slow for changes in interest rates to actually influence this one, because I mean, I wouldn't imagine there'd be too many companies out there with floating rate debt. I mean, I don't really have any visibility on it right now, but you know, if you were smart, you would have been terming out your debt when interest rates were so low, and so you know, a given hike in rates or rise in yields wouldn't necessarily have an instant impact on this, and the more likely thing to impact it would be a recession, which would, you know, donk the EBITDA on the head and deteriorate the ratio that way. So you know, in that respect, yeah, we've got rising rates, but we've still got a decent economy earnings cycle at the moment. So you know, it's almost a contrarian indicator in that sense. But you know, we'll be telling as to how this indicator progresses from here as interest rates do rise and bond yields, you know, have risen significantly as well. And speaking of bond yields, this one here is the equity risk premium, which factors in bond yields and the absolute or PE ratio valuations. Come down very significantly for the US. You can see there, you know, it's still higher than where it got to at the height of 2007. You know, the 2007 top and the .com top certainly hasn't gone negative. Still, well, I'm not sure how much it is. About 200 basis points away from that point, but you know, lately it has been squeezed on both ends by higher valuations and higher bond yields. Certainly a lot lower than the, you know, absolute highs that it got to at March 2009. Very good buying signal there, very good reason to be paying attention to these things. The other thing in there is the relative value case. UK versus US, very significant difference there. Even the rest of developed markets, quite a significant variation across markets there. So that is that. I mean, one thing I wouldn't mind doing just quickly is, if we look at the latest weekly poll, if you haven't gone and participated in that yet, go ahead and put your vote in. I wanted to show you how it's sitting so far. It's so this is for the bond survey here. Interesting how the technical spread has actually come roaring right back for bond yields, so that's interesting there. I think bond markets are definitely susceptible to a rebound at this point. Fundamentals, net bulls are rolling over for equities. Seems to be following down what's been going on in bonds for the last few weeks, so that's an interesting one. Preliminary results still, and then onto the equity one. Pretty interesting here. You can see technicals bull bear spreads actually moved down to a new low, which is quite interesting. Fundamentals are still holding up though, and I guess if I think about what my view is, it's that a lot of the fundamentals are still looking fairly decent. I mean, the trajectory of where the Fed's going from here is certainly not helpful. Definitely taking monetary policy from very supportive to progressively tighter, progressively a headwind. Global domestic economy is still running pretty well. Earnings, as far as we can tell, still looking fairly decent. So, I'd say that the fundamental backdrop, yeah, probably is still fairly decent. Valuations are up there, so it's kind of an offset there. But certainly, to go back to that previous point about contrasting this market correction versus 2015-16, we've still got a lot of improvement. We're still seeing a lot of upward momentum and across earnings, fundamental indicators. So deferring to the positive macro backdrop, and that the Fed's probably still got a way to go before it really hits the market on the head. That this correction probably is a correction. There's some interpretation open that it could be a bear market, because we have seen a few signals there that do look reminiscent of previous major market tops. And I think this correction probably could go a little bit further, but overall I would be erring on the side that it is a correction rather than a bear market. And but I will be indeed watching the charts and indicators in the weeks and days and months ahead, and defer to the facts. So that's it. If we go back to here, so yes, make sure that you vote in the survey, and be sure to follow those accounts that I mentioned on here who've I've pinched their charts for this one. And be sure to follow the YouTube channel so that you don't miss out on any updates. I'll be putting out again the weekly 5 charts, top 5 charts of the week, which are across broader macro and markets, and that will be on Tuesday or Wednesday. So stay tuned for that.